Welcome to this explainer. Today, we're literally putting on our forensic analyst hats to track the digital footprints of the financial market's absolute biggest players. We're diving deep into the inner circle trader, or ICT methodology. We are going to break down market structure just like professional analysts do, decoding those charts to see exactly what's happening behind the scenes.
So, we've all been there, right? Have you ever wondered why your stop loss seems to trigger just moments before a massive trend reversal? You set your position, the market dips just enough to knock you completely out of the trade, and then boom, it immediately rockets in the exact direction you originally predicted. I mean, it feels personal, doesn't it? Well, it's actually not personal at all. It's structural. And that leads us to the single most important question in trading. Who is really moving the markets?
The answer lies with what we call smart money. You know, the central banks, the huge institutional traders, the market makers. These guys operate on such massive scales, accumulating huge order blocks to drive major price shifts. And today, we're going to completely expose their behavior. By using the ICT strategy, we can stop being the victims of these sudden market shifts and actually start analyzing the structure to anticipate them.
Okay, here's our briefing document for today's explainer. We're going to quickly cover the smart money advantage, the 7 footprints of structure, spotting the liquidity sweep, confirming the market shift, execution and risk management, and finally we'll wrap up with the analyst's final verdict.
Let's jump right into Section 1, the smart money advantage. The absolute core problem facing everyday traders is really just a matter of perspective. Retail traders, they typically just react to price movements. But as an analyst using ICT, you quickly realize the market actually operates on this hidden 24-hour cycle. It starts with an Asian trading range, moves right into London session manipulation, and then finishes up with the New York session. Smart money uses this exact cycle to accumulate their positions during correction phases, and they'll often break short-term support and resistance just to gather up orders. Your goal as a professional analyst is to spot the precise candle where this institutional order flow begins.
All right, moving on to Section 2, the 7 footprints of structure.
So, to track this invisible force on our evidence board, the very first footprint we look for is liquidity. Check out those buy-side and sell-side zones. These are the extreme tops and bottoms of price patterns where everyday retail stop-loss orders are all clustered together. And to smart money, these clusters are basically a giant magnet. They literally need this liquidity to fulfill their massive orders. So, tracking market structure fundamentally begins with identifying exactly where the retail money is hiding.
Our second clue is displacement. Listen, when institutions strike, they definitely don't do it quietly. Displacement shows up as these forceful, consecutive long candles moving super aggressively in one direction, usually with very minimal wicks. It's a huge, flashing signal of a massive, sudden surge in buying or selling pressure, and it almost always happens right after prices hit one of those liquidity levels we just talked about.
Now that violent displacement leads directly to our third footprint, the market structure shift. A normal trend is just, higher highs and higher lows. But when displacement completely fractures that pattern, violently tearing through previous support to create a lower low, that right there is a market structure shift. For a forensic market analyst, this is absolutely crucial. It's the key reference point signaling that a major reversal might be underway.
Footprint number 4 is inducement. Honestly, just think of it as a trap. Look at that mini countertrend peaking within the larger trend. According to the ICT methodology, this is essentially smart money deliberately hunting stop losses on lower time frames. They're inducing retail traders to jump into positions in the wrong direction, snatching up their liquidity, and then immediately resuming the real trend. It's brutal, but brilliant.
Okay, footprint 5 is the fair value gap. Because displacement happens so incredibly fast, it actually leaves an anomaly right on the chart. Look closely at this specific 3-candle sequence. There is a literal, visible gap between the wicks of the first and third candles. This gap acts just like a vacuum. You know how nature abhors a vacuum? Well, the market hates inefficiency just as much, so price will almost always return to fill this gap in the future.
Footprint 6 is the optimal trade entry. Once a market structure shift and a fair value gap are locked in, professional analysts don't just jump in blindly. No way. They use Fibonacci levels to pinpoint exactly where smart money is going to reload their positions during a pullback. This optimal trade entry zone almost always falls precisely between the 61.8% and 78.6% retracement levels.
Finally, for a 7th footprint, we look for a balanced price range. This is a highly volatile zone defined by 2 opposing fair value gaps that were created in a really short period. The key takeaway here is that price will violently fluctuate up and down within this range, testing the extremes to fill both of those gaps. As an analyst, your job is to wait patiently during this chaos, knowing for sure that a definitive, explosive trend is going to resume the second price breaks out of this balanced boundary.
All right, let's head into Section 3, Spotting the Liquidity Sweep.
So how do all these footprints build our primary strategy? Well, this lethal setup operates in 3 distinct phases. And unlike some of those strategies that require endless waiting, this one requires immediate, calculated action based entirely on how price interacts with liquidity. You spot the sweep on a higher time frame, confirm it on a lower time frame, and then execute. Let's break that down.
Step 1 happens on the higher time frame. Keep your eyes on the sell-side liquidity at the previous low. The setup triggers the exact moment we see price rapidly drop and clear out that retail sell-side liquidity with just a single dramatic candle wick, before violently reversing upward. That single wick is everything. It tells us smart money just grabbed the exact liquidity they needed to fuel a massive move.
Which brings us to Section 4, Confirming the Market Shift.
Once that dramatic sweep happens, a true forensic analyst doesn't just guess. We immediately drop down to a lower time frame. Right here, we patiently watch the structure for a change of character, or CHOCH for short. This happens when the lower time frame structure suddenly shifts directions and breaks a previous high. This is your definitive secondary footprint confirming that the institutions are totally done with their stop hunt and are now driving the market the other way.
Now, execution is the critical next step. Once that change of character is confirmed, you find the newly formed order block or fair value gap left behind by the reversal. This is the fun part. You set your limit orders directly inside this zone. You are anticipating the precise moment smart money pulls back slightly before rocketing off. You can actually even combine the gap in the block, placing your entry right smack in the middle.
Let's move to Section 5, Execution and Risk Management.
Because let's face it, knowing exactly where to enter is completely useless if you aren't protecting your capital from the very institutions you're tracking. Professional risk management means placing your stop loss safely below that block. And this is absolutely crucial. You always include a buffer for the spread to avoid being taken out by minor slippage. For your target profit, just aim your crosshairs directly at the next opposing swing high. That gives you a perfectly clear structural exit point to lock in your gains.
And finally, Section 6, the analyst's final verdict.
Let's step back from the evidence board for a second. Is tracking smart money through ICT actually worth all this effort? Well, the reality is it's a bit of a double-edged sword. On one hand, the ICT approach offers an incredibly high win rate. By mimicking institutional logic and putting your orders exactly where retail traders place their stops, you get a massive structural advantage. But on the flip side, it comes with a steep learning curve. It requires immense patience because you have to deliberately limit your trade frequency. You only strike when the forensic evidence, the sweeps, the gaps, the shifts, aligns perfectly.
But I'll tell you this, once you learn to see market structure this way, you really can never unsee it. You now understand the mechanics of the 24-hour cycle, the raw power of displacement, and the total ruthlessness of the liquidity sweep. So, the choice is up to you. Study the evidence on your charts, fiercely protect your capital, and decide, will you track the smart money or are you going to become their next liquidity? Thanks so much for joining this explainer. Keep your eyes on the structure.